Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, so this week we're going to actually look into a trade in Caterpillar. It's kind of the theme that we've had over the last month and in this earnings season has been, let's go bottom fishing. Let's look at how we can use options to try to buy stocks that we like by selling cash secured puts or cash secured put spreads, if you'd like. Other ways, other strategies where we might bottom fish and limit our risk if we're looking to buy stocks is buying deeper in the money call options, going out further in time. Today, we're actually going to look at a fig leaf. Caterpillar announced earnings yesterday and today, this morning, and they, with their earnings report, they have been beaten down a little bit. So we're going to talk a little bit about, well, what can we do after an earnings report to try to partake if we're looking for basically the good old dead cat bounce in Caterpillar going into the end of the year. So talk a little bit about that. But before we get too far, let's see what's going on in the markets. If I share with you my VIX watch list, what we're looking at in the VIX, we saw that come down once again. The VIX is one of the fear index is not really showing much fear in the marketplace based off of what we have seen. We've never had that capitulation moment where we had the big VIX. Well, some might say or argue that there could be a capitulation moment. If we could see the VIX spike up above that 40 level and hit the 45, 50 level, we just never have had that big downturn ever since the market has taken a turn down. And now we see the VIX even lower than it was last week, 2290, just up a fraction today. S&P 500 index is just up a smidge too. NASDAQ is up. We've had mixed markets, a lot of chop in the markets recently. If we look at the S&P 500 index chart, we see some good signs here. One of the things that I'm going to point out is the green line on the chart is the 20-day moving average, and this is the 50-day moving average here. So we want to get our ducks in a row. We're a long ways away from the 200-day moving average, and we have been below the 200-day moving average for quite some time now. But to start with, if we want to get above that, which we would prefer to be as far as charts are concerned, we need the 20-day to get there. The 20 days got to lead the way. So we have what's called a golden cross going on, where the 20 is crossing over the 50. Don't put a lot of weight into it. I think it makes a little bit more sense when you see the 50 actually cross over the 200. That's a little bit more effective because you see a lot of fluctuation between the 20-day and the 50-day. But here, when you say there was a death cross, well, we saw the 20-day moving average cross below the 50, and that actually carried a little bit of weight because we did see the market have a pretty strong downturn after that cross happened right there. So it's just worth noting. I don't think you would ever put a ton of weight in it, but A lot of people are talking about the 4,200 area as a resistance in the S&P 500 index. We got a little bit of chop, but we've seen some strength in the marketplace. The mega caps last week came out, and it seems like Wall Street is willing to give a pass on not so good numbers on earnings, looking a lot at forecasts going out into the new year, and the forecasts are still showing growth. So even though we've had 2 negative quarters of GDP, the forecast from a lot of the megatech, especially the tech, megatech FANG stocks, et cetera, are that we are still going to have growth going into the end of the year. It's slowing, but it's still there. And so a lot of mixed messages. We have the 10-year and the 2-year as far as treasuries are concerned. That has been inverted for quite some time. People talked about it a lot up until it happened, and now a lot of people aren't focusing on it. But that is, by definition, one of the signs that usually leads the economy into a recession. And yes, we've had 2 negative quarters of GDP growth, but now people are saying that we're going to have a soft landing. All right. Strong things, earnings are still continuing to grow, even though they're slowing. And obviously, everybody's focused on the unemployment area. Commodities are coming down. A lot of people think that we may have peaked on inflation in the commodity marketplaces. Oil, wheat, semiconductor prices even have started to wane a little bit, which is good news overall. So mixed metaphors once again in the marketplace. A down day to start with today. Now we're a little bit flat. So I do expect just chop going forward in the market as far as the S&P 500 index. We're going to get through the earnings report, and the Fed may slow down a little bit. We have a little bit of a break. We have Jackson Hole in August, where there could be a potential move, but most people don't think we're going to do anything out until September to the next big Fed meeting. Okay, so last week we no longer have a stock play of the day overtime, so we always address last week's trade, and we looked at Amazon. We looked at buying protection in Amazon. So the question is, this is a very important question for option traders. Did the trade work out? Did we like our trade last week? We said we were exploring protection in Amazon going into earnings. A lot of nervousness based off of a couple of bad retailer earnings reports, some bad reports as far as advertising is concerned, stocks like Snapchat. But Amazon's a different beast. Not to mention they have web services, which is just as big, almost as big as their retail world. So their growth, it's a tough thing to understand as far as Amazon is concerned. Trying to get everything right. So if you were nervous and thinking about selling, we gave you an alternative. We went in and looked at what the expected move was based off of where the most at-the-money option contracts were trading, and we bought a spread that would protect us if that expected move happened to the downside. It was around 10 points. So we took we lowered our cost a little bit. We took a small deductible of a couple of points in Amazon, and then we bought a 10-point wide bear put spread as protection. Now, the preference was maybe there were a lot of people that bought Amazon after the split. Part of the reason why companies do splits is to make it feasible to be able to buy 100 shares of stock. So that was the preference. If you were nervous about it going into their earnings report, why not buy some protection as opposed to going out and selling the stock outright? And so we did. We spent a couple of dollars to buy a 10-point wide spread, and guess what? Amazon came out and the stock gapped open more than the expected move to the upside. And on the stock play of the day last week, I said, if you're doing this strategy, you are still bullish on the stock. You're still better off if the stock makes a big move to the upside as opposed to the downside. So, I mean, you can kind of look at it this way. When you buy car insurance and you go your 6-month period or whatever your policy lasts, and if you don't crash your car into a tree, are you disappointed? Right? Well, you spent money, you protected yourself in case the worst case scenario happened, but it didn't happen. So you pay for another policy and you move on. In our instance, we had one specific event that we were focused on. And because it was around earnings, we, instead of just buying a put outright, we did a long put spread. Well, guess what? The long put spread didn't help us. Why? Because the stock made a strong move to the upside and more than covered the loss, per se, of our insurance product or our premium paid for it. So this is where option trading is tricky. Some people will come in and say, well, I hear weird things which just aren't accurate, like 80% of options expire worthless. That's why you should always be selling options. There's really no logic behind that. That's always been a misnomer. So in this instance, we lost money on our option trade, but we stayed in the market because we bought some protection. So did we really lose money trading options? Well, on the books we did, but we made up for it and then some by staying long, quote unquote, our 100 shares of stock. And remember, we always hear on the stock play of the day, nothing's meant to be a recommendation. We usually do things in just one share, one lots if we're looking at options and considering 100 shares in the underlying stock. So to me, the strategy worked perfectly. Exactly what you would want to happen, happened. And if you remain long your 100 shares, the stock here, Amazon, was right around on the day. We can look at the close. Where was the close? Okay. Close was 122. And then the very next day, the close was 134. So more than paid for our protection on Amazon going into that earnings report. Okay, so not much to talk about. Go on to the next trade. Let's look at CAT. Okay, once again, not meant to be a recommendation, but Caterpillar now, and I'd be more apt to do this type of strategy after the earnings report. Caterpillar is a fairly expensive stock, $188. So to me, this is a real good candidate for buying a deeper in the money option contract as a substitute for owning the stock outright. If you're buying 100 shares of stock, you're talking about $18,840. So that's plausible to buy 100 shares of that stock, but why not buy the right to buy 100 shares of that stock? Basically, we're going to rent the stock, if you will, or use an option contract as a surrogate for owning the stock outright. We're going to do about 20% of the total cost to buy the shares outright, but we'll still get upside exposure. Now, Caterpillar missed on earnings. They had a disappointing earnings report, even though the CEO came out, Jim, and said that the demand is strong, but once again, we're getting mixed messages on supply chain constraints. And the fact is across the globe, they're seeing strong demand, but they cannot meet those demands because of their suppliers, and the suppliers of their suppliers are all having issues just getting product. Okay, so one other thing that happened in this quarter is we did see that the CEO actually came in and bought some stock at these lower prices. So let's look at a strategy that in this environment will lower our risk compared to buying the stock outright, but still give us some upside. And because we have so much downside in the underlying stock today, we're actually going to sell a call against that position. So we're going to take advantage a little bit of the volatility. Even though volatility came in as it usually does after earnings, we still see some volatility, but now a little bit more predictability. That's where I want to be when I'm considering covered calls and the strategy that we're going to talk about today, which is a fig leaf. Okay, so inside my book, The Options Playbook, here's the companion website. We're looking at the fig leaf. We actually have this down as a rookie's corner play. It's still a tough play in that you're buying an option as a substitute for the stock. And then we're going to try to copy what a covered call would look like. If we bought 100 shares of Caterpillar today, I would strongly consider that earnings have already came out. So I would consider just selling a covered call on that 100 shares. So we're going to do the same thing with our option contract. We're buying this deeper in the money option contract as a surrogate for owning the stock. Stock is down, might take we're obviously not expecting it to get all the gains back tomorrow. Who knows what can happen in the markets, right? That's not what this show is about, trying to predict where the underlying stock is going to go. It's trying to take a situation and apply an option strategy to the market conditions. Down move in Caterpillar, let's try to bottom fish. Let's buy a deeper in the money call option and sell a shorter term out of the money option against it. All right, so I'm going to go to the Ally Invest option chains and we're going to look at the strategy today. Before I do that, though, I want to remind you that this is an interactive show. We want you to participate. So please go over to the chat box. And if any questions or concerns popped up in your head while we were just talking about what happened last week in Amazon and anything that's happening with this week with a lot of things that I just talked about on Caterpillar, please put your questions, concerns in the chat box and I'll try to address them at the very end of the show. Okay. So now I'm running over to the Ally Invest option chains. We see the chains here. We have Caterpillar up. Right now, the market is, well, it's actually made a little bit of a bounce. This morning, it was down more than that. Now it's down $6.32, only about the 3.25%. So if we go out further in time, I'm going to go out to January 20th of 2023, 171 days away. We want a lot of stock price representation. So what we're going to do is we're going to buy a deeper in the money leap option. Now, I've addressed this a lot of times when I've looked at this type of strategy. Our biggest concern with buying deep in the money option contracts, longer term option contracts as a surrogate for the stock is the width between the bid-ask spread. We're not bad. We got decent volume in the stock today because of the earnings report and also in the options. So we're 35.85 by 36.40. Not a great market. We'll probably try to work it somewhere around the 36 level. But if we could get as tight of markets in the longer term options as we do in the stock, this strategy would be by far the most popular strategy in option trading. But you're dealing with wider bid-ask spreads when you get deeper in the money and go out further in time. Okay, not disappointed in this marketplace. Think it's a feasible market to be able to apply this strategy. Okay, so if I look at the short term, they just announced earnings. We're going to look at the August 19th expiration, 17 days away. Now, if I had bought 100 shares of Caterpillar, I might consider selling the 200 strike call, or maybe even the 197.50 strike call. You're bringing in a good chunk of change, but it's relative to buying 100 shares of stock. So we're not going to have to put up all that capital, and we don't own the stock. So when I'm looking at a fig leaf compared to a straight out covered call, I want to go up a little further in strike and sacrifice some premium. Because I really don't want to be assigned on August 19th in 17 days. I want to avoid assignment. By going up in strike, that gives us a little bit more room for, just a little bit more room in general to not be assigned on our short-term call option. Okay, so that's going to be what we're going to look at. So we're not going to sell the 200 because it's not a covered call, it's a fig leaf. We're going to sell the 202.50, still getting some real good premium. We see the implied volatility is still at 32%. That's a decent amount for Caterpillar. And we're $1 by 120. So here's the official paper trade. I go down to the Ally Invest option strategy workbench. We're buying the longer term January 20th, 2023 160 call. We are going to be selling the August 19th, 17 days away, 2250 call. Looking to do it somewhere around the midpoint of 35.12. Might have to give up a little bit more. Maybe let's put it in at We'll go 35.20. That's going to be we always are fishing for a midpoint, especially when we're coming in on a spread. We're giving them, the market makers, a buy and a sell. So sometimes they'll give you a little bit more leeway. So the total debit to the account will be $35.20 or $3,520, as opposed to going and buying the stock outright, which would be $18,866. All right, so that's the official paper trade this week, and let me read it off here. Buying to open the January 20th, 2023 160 strike call, and at the same time looking to sell to open the August 19th, 2022 75 strike call, looking to do this for a net debit of $35.20. Never a guarantee of a midpoint fill. Don't forget, you got to add commissions in. But with that said, that makes our maximum risk on this trade $3,520 if we were to execute at that price. All right, so let me remove the right rail here. And if you think about a covered call, one of the biggest things, well, actually, let's just run to the fig leaf inside the options playbook. You know, the covered call just has straight lines. So the thing about a covered call is you can just put it on and, you know, basically fall asleep. If you're not worried about the downside on the stock, because the stock creates the risk, and that risk is to the downside. But if it just goes up, well, you own the stock. Let them call it away at a higher price. You just sell your stock higher than where it's currently trading. Not that big of a deal, right? Well, in the options marketplace, that's not true, because you still own an option, you don't own the stock. So you got to do something with that option contract. So as I mentioned, we really don't want to be assigned on this. So I'm going to highlight inside the options playbook in the managing positions, rolling a covered call. So I just have a little bit of rules. This is one way to try to avoid assignment. And if you've never done a covered call position or a fig leaf like this, especially a fig leaf, I would suggest doing a covered call before doing the option version of it. And you definitely want to read this. This will be your homework, if you will. You want to read this section in managing positions about rolling a covered call, and when you would want to do it to attempt to avoid assignment. All right, so I'm going to run over to the chat box, and let's see what we have here. Okay, Clinton Andrews, 775 call or 2250. Clinton, I don't know what 75 call means. 2250. Yeah, I want to do the 2250. If I am looking at doing the 2250 call, I'm going to err. Well, I guess if I'm ever, I might even look at the 200 and 250. I would even consider the 205 call, actually. It's under $1 that we'd be bringing in premium, but I would prefer to err on bringing in less premium and selling a little bit higher call option when I am looking at a fig leaf as opposed to a covered call. It was on your screen, 75 call. Okay, let me run back and you stay right here. I'm going to just take a quick peek at the chain. No, we're not. 160 strike call, Clinton. So the 160 strike call is the one that we're looking at. The 200 and the 202.50 call is the one that we're looking at selling. If I look at the 205 call, it's actually trading 77 cents by 86 cents. So maybe you get it done for 82, 83 cents. That's not bad on a one-by-one basis. If I give myself 2.5 points, I take another 20 cents off the table on that. We'll be doing all right. All right. All right. Well, I'm not quite sure on the last screen. I think I'm just going to move on. Do we have any other questions to address here? Last chance, last call. And if not, well, thanks for coming to the stock play of the day. please click subscribe, ring the bell, and you'll get all of the alerts for the stock play of the day. Also, you might want to check out my little landing page that will tell you a little bit about all the things that I do week in and week out. If you go to ally.com/investeducation, you can sign up for our weekly educational event email, and we send it out only once a week, and it just sums up all the things that we're doing over here at Ally Invest as far as education is concerned. Thanks for coming, everyone. Please click subscribe, ring the bell, and we'll see you this coming up Tuesday for the next stock play of the day.